Good evening, everybody. Uneducated Economist here. So I have been listening to an interview on Macro Voices, and this is a really, really good interview. It's Eric Townsend is interviewing Dr. Lacy Hunt, and this interview really does a fantastic job of describing our current situation of deflation and why we're going to experience deflation going into the future. And really what it breaks it down to is the way that the Federal Reserve conducts business, because it's kind of this idea that if the Federal Reserve is printing up money and injecting that into the system, it's at some point that we're going to see inflation happen. And a lot of people kind of think that way, and I did as well for a very long time. And it has to come down to velocity of money, but it's not just the velocity of money in the Federal Reserve printing up money. What it has to come down to is the way that the Federal Reserve is injecting that money into the system. And pretty much what it comes down to is that the Federal Reserve cannot buy anything, right? They are basically, the Federal Reserve Act is forcing them to loan money into the system. And this money that they're loaning into the system is generally treasuries and mortgage-backed securities and things of that like. And that loaning into the system has dropped interest rates. And now the return on investment has diminished so much that the deflation, the money velocity that comes from it, has decreased as well. The profits that you get from loaning your money into the system has dropped dramatically. And I know that's kind of hard to wrap your head around, but basically it's return on investment. And that bonds right now have such a low interest rate to them that when you go to buy a bond, there is no return on the investment. The only return that you get is by anticipating that you're going to sell this bond into the future for a higher price, so long as the interest rates continue to drop. And as we run into this lower bound, it's going to force the Federal Reserve to continue to buy these bonds, keeping the interest rates low, diminishing this return on investment. And as long as people don't feel comfortable with this whole, return on investment, then you're going to see the velocity of money stay slow and stay very low. So I know this is kind of hard to wrap your head around, but at an hour and 4 minutes into the interview, and I'll leave a link down in the description for you guys, Eric Townsend really describes it very well. And so I would go and listen to that video, and really the interview starts getting really good about 45 minutes into the video. And I think the whole interview is about 45 minutes long, but the length of the video itself is about an hour and a half. But the interview itself is about 45 minutes, if I remember right. But anyway, that situation right there, where the return on investment from buying the bonds has diminished so much that there is no velocity coming from the Federal Reserve's actions. Now, this is where the velocity can pick up, or at least the inflation part of things can pick up, is that the Federal Reserve was to change the way that they do their business. And now this would take an act of Congress, because the Federal Reserve Act kind of limits them on what it is that they can do. Okay, now a lot of people say that they're injecting this money into the system, but they're not really doing that. What they are doing is they're buying treasuries, they're buying mortgage-backed securities, they're buying these instruments of debt that have already been created. If that was to change, where they could literally send checks to the people directly from the Federal Reserve, then that would be where the inflation could really start kicking in, because that would start creating a lot of bad money. And that's where Gresham's law would kick in, where bad money would start chasing good, or basically the good money would chase out the bad. People would start buying commodities because the prices would be going up. And so if they don't see a return from the bonds or from loaning the money, the financial instruments, then they're going to start getting into commodities. And the more people start getting into it, the faster the prices on those commodities would start kicking up. So as long as the Federal Reserve is limited on what it is that they can do as far as injecting that money into the system, then we're going to continue to see a slowdown in the velocity of money, even though they're printing massive amounts of it up. Anyway, I hope I explained that correctly. Please, I would love for you guys to go and watch that video, watch that interview from Macro Voices with Eric Townsend and Dr. Lacy Hunt. And let's have a talk about this, because this one was really a mind opener for me. It really kind of gave me a very clear idea of why it is that the Federal Reserve's actions are not creating the inflation that everybody would anticipate would happen right now. Anyway, Uneducated Economist, you guys let me know.